Good afternoon, everyone. This is Bob Dole, President of Solution Driven Wealth. Today is April the 25th, 2023, and we're here to provide our Q1 2023 outlook and kind of give you some tips for what's going to happen, we think, in the second quarter of 2023. As always at Solution Driven Wealth, and our message to you is that our main concern is for the health and well-being of your family and your loved ones. We're always here to answer any and all of your questions, whatever they may be. The first quarter of 2023, as you know, is actually a pretty decent quarter in the equity markets, and this piles on or continues a trend that we saw really in the fourth quarter of 2022. You wouldn't know it, unfortunately, from the financial media because they're reporting, unfortunately, unfavorable or recessionary type talk, in our opinion, misguiding and misleading investors and not stating really what's happening and occurring in the markets today. A bit of a change from the fourth quarter of last year to this quarter, where value-oriented securities really carried the day in 2022, at least in the fourth quarter, to this point in this time of the year, where growth stocks have really begun to rally and accelerate. So it always points to the adage that it's always good to have your toe in both waters, both in growth and value-oriented securities as they come in and out of favor. Trying to time when to get out of these securities is a fool's errand in our opinion, and it does deserve a mention here that you stay allocated across all asset classes in most cases. As most of you know, we've been discussing at length inflation and the Fed's attempts to combat inflation by raising rates at the fastest pace really in the last 50 years. So this is starting to actually have an impact on inflation. So we've seen inflation go down from 6.4% in January all the way down to 5% here in March. So at the end of the Q1, really a noticeable change in inflation, leading us to really think that the Fed is very near, if not near, the end of their rate tightening cycle. As you can see from this chart, interest rates have certainly been on the rise in the last couple of years here for sure. However, at this top ebb at around 5%, we are starting to see a sign that the Fed will certainly pause here. Some pundits are saying that the Fed will actually begin to decrease rates very rapidly. We are not of that opinion. We think it took the Fed a very long time to get to this point. They're very concerned about inflation heightening once again, and we think that they will pause and remain at this level for quite some period of time. We do, however, think that on the intermediate side, 12 to 24, 36 months, the Fed will return rates back to a terminal rate between 2 to 3%. Despite the Fed raising rates, an interesting anomaly is occurring. The 10-year Treasury, which really governs most all lending in our country, that's mortgage rates, car loans, and everything else, went from a high of 3.89 in the first quarter of this year and has ratcheted down to 3.48% at the end of the second quarter. First quarter rather. As you see this doesn't fundamentally make sense, but it does tell you where people think the puck is going, that rates are going to trend lower, and we're going to see this in lower borrowing costs and lending costs to consumers. It's always important to understand the inverse relationship between interest rates and bond prices. As we've said many times, it's essentially a seesaw, where if we have interest rates going up, bond prices decline, and the opposite is true as well. We're looking at a situation now where we've been short-term in our thinking on interest rates and with bond maturities. So floating rate securities, short-term interest rates deserved, we think, a predominant place in your portfolio. We are, however, getting to a point now where at the Fed, as the Fed nears the end of its rate tightening cycle, we may very well want to lengthen some of these maturities, what we call duration, on your bond portfolio. So be prepared for that when we discuss that in your quarterly reviews. So let's go down to the basics of what you might hear in terms of an economic report. Say a major company like Amazon, Apple, or Google reduces its workforce. Some people might think that's a negative impact to the stock. In fact, in our view, if you're a longer term investor, it's actually a bullish signal, in our opinion, to the stock, because profits for a company drive the stock price higher. It's no more complicated than that. When you're getting bombarded with news and you hear that a company is laying off workers, why it might not be great for that worker for sure, from a cold-hearted standpoint of evaluating the stock and its profitability, it should eventually increase profits of the stock, of the company rather, and should move the stock price higher over the intermediate period. We will always have geopolitical crises. It is not a reason to stay in cash or be uninvested. So what are some of the key takeaways from our first quarter review and as we look at the second quarter and beyond? Well, we really think that the Fed is near or at the end of their rate tightening cycle. That's usually a bullish signal for stocks. Borrowing costs, while they have increased, are certainly starting to come down. Take attention to that 10-year Treasury note, which governs most lending in our country, coming down at the end of the first quarter. This also means that we want to review your fixed income investments. We've had short durations or short maturities on your fixed income portfolios in many cases for a logical reason. Those bonds were much less subject to interest rate risk than longer dated maturities. But now the opposite is true. We're starting to get into a situation where the Fed may be leveling off or in fact decreasing rates. And if that's the circumstance, we want to gobble up some longer dated maturities that we can hang on to for a longer period of time so that we get stuck with a bond or all of our bonds maturing when we can only reinvest at maybe 2 or 3%. Might make a lot of sense to invest here when we can get 4 to 5, maybe 5.5% on some of these bonds to buy. The financial media has done us a really huge disservice, overhyping the banking crisis in the first quarter, making it feel like we were revisiting the 2008 and 2009 financial crisis. The fundamental job of the Federal Reserve is to provide for an effective, productive banking system. We've been in a very good rally since last October. October of 2022, we've had a pretty good rally in the equity markets, with the S&P 500 being up about 16% since that time frame. One of America's most famous investors, Warren Buffett's annual letter to shareholders in 2023 pointed out that, he's a big believer in America, and he's never really seen a time where it's made sense to bet long term against American success. We are of the same mindset. We believe in our system, our economy, and the success of investors in it, as long as they pay attention and I think follow a prudent strategy that's unique to their specific goals and needs. We think they'll have great success in these markets. We thank you again for working with us and your attention to this economic report. We wish you the very best as we head into the second quarter of 2023, and have a great finish to your week.